morning. I'm Eric Edmondson from DC Advisory. Welcome to our session this morning, Paths to Liquidity. First, I'd like to thank the Montgomery team. Yesterday, I think we can agree, was a great day. Lots of meetings, very energetic. Last night at the Getty was just fantastic. So thank you to the Montgomery team for this. It was a great event. Today we have a group, and we're going to talk about liquidity in 24. And I will ask each of the members to introduce themselves before we get into this. So, Tim?
Thanks, Eric. Yeah, I'm Tim Armstrong. I'm a principal on the investment team at SageView Capital. SageView is a growth equity firm primarily focusing on meaningful minority investments in B2B technology companies. Representative investments here at the summit today would be Disco and Pax8. Great to be with everyone.
I'm Michael Brown. I'm a partner at Fenwick & West, splitting my time between our Santa Monica office and our San Francisco office. I represent tech companies through all stages of their life cycle, from formation through liquidity paths. And I also have the pleasure of working with Tim on Disco.
Great. Nice to see everybody. Jack Castle. I am with NASDAQ. I am our head of new listings. In my role, I oversee NASDAQ's IPO business for the Americas and EMEA. So working with private companies as they're working through that process and transition to the public markets.
Thank you. Well, I think we're probably happy that 23 is over. Rising interest rates, inflation, Fed tightening, restrictive credit resulted in an IPO market that was essentially shut. It resulted in an M&A market that was down 40% on transactions year over year. Private market was very selective in their financing activities, and there was a great fear of recession. And so with that as the past year, I think we look forward to hearing about the upcoming year from everybody and sort of what your thoughts are on it.
Yeah, I mean, you mentioned M&A being down 40% in the part of the market I spent a lot of my time in, both on number of transactions and volume. It was down as much as 50 to 75%. So hopefully we're comping off a low point. But I think in a lot of areas, we're starting to see some green shoots. A lot of folks in this room track public software indexes. Feels like based on early results, Q4 net new ARR is back to kind of an all-time high, which is a green shoot that I think we're all excited to see. So, it's an overused phrase, but I think sitting here in early March, for me, particularly feeling more cautiously optimistic than most.
Yeah, I might have a slightly more dour view on that. I think capital markets is largely going to remain shut through most of the year. I know Reddit's on file to go out. I think there's a pretty big question on how that's going to perform. They're betting a big part of that story on AI, and I think it'll be interesting to see how the street reacts to that. But what I'm hearing from companies and banks and the like is, unless you really need to get out, most companies are targeting 25 because kind of why take the chance in a pretty uncertain market. M&A, I think we're hopeful for some, to put it your way, some green shoots, some activity in the latter part of the year. I think right now there still tends to be a pretty big gap between the valuation expectations of the targets, especially companies that maybe raised last a few years ago at the height and have expectations that are out of line with the current market. And then you have buyers that, especially if you're a public buyer and your stock's trading at a certain multiple, you're looking at a target and not willing to pay up for it. And so I think we're still seeing that valuation mismatch. I think hopefully as you get into the latter part of the year, those will start to converge, especially for targets that are unable to raise private company capital, can't go public, and so their only path really is an M&A deal. And so I think we're kind of hopeful to see some of those deals come together.
Yeah, I'd echo that, but I think slight caveat with the point of we do see a lot of companies that are pins up, drafting, keeping their filings with the SEC up to date with their audited financials. So a lot of the growth companies, we have Reddit and Astera Labs, a chip-related company in Sunnyvale, that are planning late March. We do expect maybe 4 to 5 scaled growth companies targeting kind of the Q2 range. Now, again, the market has to be there. But then we're also seeing a good cohort of scaled businesses, typically private equity-backed businesses that are pins up drafting. Now these are north of 500 million in revenue, maybe a smaller, slower growth, kind of 10 to 15%, but profitable businesses. And again, a different impetus to go, to your point, on why go public and in this market, what is the risk reward. But for these scaled businesses, there's a bit different impetus and reason for them to get to market. So we do expect a few more IPOs through Q2, I think, and we'll touch upon it a bit. We've got the election cycle obviously heating up, and then that'll be a large catalyst there in November this year. And so we expect activity with a lot of deals pushing into 24, and I think, or excuse me, into 25. And I think to Tim's point, as we look at the indices right now and where the markets are currently trading, with NASDAQ specifically hitting an all-time high, as well as the S&P and Dow, a lot of private companies are now looking back to those multiples saying, oh, well, you know, perhaps we raised capital at a large 20 plus times revenue. As you look at broadly software or tech being at the high end of that revenue multiple, right now it's about 10, but we're seeing Cloudflare and we're seeing some of these other public companies trade back to 18 to 20 times. And so it's the art and science from a valuation perspective on resetting expectations. And as we've looked over the last 24 months, as investors, specifically the buy side and public investors, reorienting from growth to growth with cash efficiencies and a path to profitability, there's still that dislocation in the bid-ask spread. And as that continues to narrow and we get some of these deals done, including M&A, hopefully that will prompt more activity in the IPO market.
Well, I think targeting is the key word you said there, right? Like targeting Q2, right?
Fair.
And like, I've, certainly had companies that have been targeting, the last 6 quarters, right?
Yeah.
Like when the market opens, that's our target. And so I think the problem is it continues to slide out. And you and I were talking backstage about it, right? Everyone had the close eye on Klaviyo's offering last year. As a good old-fashioned traditional enterprise software company, very different than ARM or Instacart or Reddit, right? And that, the performance there, I think, definitely spooked a lot of your traditional software companies because of how that has performed since the offering.
Yeah.
Yeah, litmus test for me is, some of those companies that were, on the shelf, ready to go public before the market turned, when will one of those come back and test the market? Because they are already presumably feeling some of the liquidity pressures, right? And so I think that'll be a benchmark for me once one of those is able to actually get out there and test the market.
Right.
Jack, how about the so-called private IPO market?
The private IPO market. So
A lot of people are talking about it. That's the alternative.
Yeah.
That's what they should think about.
Absolutely. So
What is it? How does it work?
I think it's interesting, as many may know, but so back in 2012, actually, NASDAQ has NASDAQ Private Market, and there's a few of the team run around here as well. But this is, we created a platform. We saw a lot of companies delaying their plans to go public, and this is really post-Jobs Act, that prior to the Jobs Act, you could only have 500 shareholders on the cap table, and then post-job, and that really forced companies, as they scaled later stage, that they actually needed to go public. So post-Jobs Act, it released that cap, and therefore companies could stay private longer. And as we looked at that, our thesis was, okay, as companies are staying private longer, there will be liquidity demand and constraints here. So how do we create a platform that can support and efficiently help them execute liquidity programs, tender offers, and buybacks? So fast forward to today in 24, we're continuing to see an increase in volumes in private companies looking at these opportunities to provide, whether again it's a structured liquidity tender offer, or a buyback, or even an auction where they let the market and a group of investors set the price, and then they go back to their employees or early shareholders and allow them to share a portion of their stock or holdings to this set of qualified investors. So I think it's directly correlated to what we see in the markets, very similar. The bid-ask spread was large in the secondary and the private markets over the last 18, 24 months, but we're finally seeing that start to decrease, that spread start to decrease. And I think another interesting trend is we're seeing an uptick in participation levels for those shareholders that are looking to sell and participate in these liquidity offerings. So over the last 2 years, it was about 40%. Now we're seeing up towards 70, 75%. And that also is just a key attribute for these private companies to attract and retain talent, right? So if the company's delaying that IPO a lot, especially for growth companies, a lot of the comp will be tied to their equity. And so if that company's now not going to go public for another 24 months and they're saying, hey, my kids are now in college, I started here as an engineer 8 years ago, this gives them that opportunity. So we had just executed the Canva tender offer. We saw Stripe obviously did a big one, and there's some bigger names in market right now that are starting to leverage this platform.
Yeah, I mean, I do think, though, we're still significantly depressed from where it was a few years ago on secondaries, where it was almost without fail, you do a financing, and then there was a secondary component stapled alongside of it. And what, at least I've seen, I'd be curious to, Tim, what you've seen, but a lot of investors that were buying common stock at the same price as the preferred, right? They now own common stock in companies where the common stock is basically buried under the liquidation preference. And so you have a lot of investors that feel like they got burned by buying common at the same price as preferred, or maybe a slight 10% discount, and now that common is absolutely layered under a heavy stack due to the valuation. And so I've seen a pretty significant pullback on secondary because everybody is still kind of licking their wounds from having purchased those shares, and it really has had a dampening effect on the secondary market where, certainly the big high-profile ones, the Canvas, the Stripes of the world, able to do it. But I think, once you get past that layer, you can start to have real issues where I have clients and they've been around 10 plus years and they have options that are expiring and they're trying to figure out what they're going to do for employees, and there's just not a secondary market there because the investors are like, or there is, but it's at a 60% discount off the last round or something extraordinarily discounted, and the company doesn't even feel good going to its employees with that because of the potential perception of what the actual value of the company is.
Yeah, I think in our part of the world, Series B plus minority investing, in the heyday, 2021, parts of 22, folks were certainly getting pushed to take on common as part of their investment. It'd be a mix of preferred and common. We're definitely back to a world where, at least from the investor perspective, we're able to get 100% of our investment in preferred. Sure, there still may be secondary folks selling common, early investors, but it's ultimately getting converted back up into a preferred that we feel good about.
Right.
Yeah.
So if we turn away from the public markets to the private, and we look at private equity, from what I read, is at an all-time high as far as hold periods, about 6 years. Limiteds are looking for some liquidity along the way. Many funds are trying to raise new funds. Does that put pressure on the private equity community to transact?
Certainly.
Great liquidity?
No doubt. We saw very robust fundraising cycles again through that 2021 period. Also very aggressive deployment rates. And now for folks that are back generally in the fundraising cycle, they're hearing from LPs, DPI, real distributions, those are very top of mind. And so those are naturally pushing through folks to think about where they can get liquidity in the portfolio back to LPs. There's certainly a tremendous amount of dry powder still available. And so I think we'll see the private markets, private funds looking to reinvest in their portfolio and use them as a catalyst to deploy in a kind of a known, efficient manner. I think the private markets are going to play a really big role in the consolidation that takes place in those markets. But a lot of those conversations are around where can you create liquidity. And I think it's creating interesting trade-offs and hard conversations around, emerging winners. How long can you let those run against your fund versus, which assets to select that you may monetize a little bit earlier to satisfy some of those LP needs.
Well, this concept of continuation funds to continue some of those investments, is that still going to be popular?
I think so, for folks that really know they have a winner on their hands that they want to keep investing and there's opportunity in front of. It's not something we've done yet personally, but it's certainly something we're seeing in the market, conversationally. Yeah.
And Michael, do you see it in the boardroom? Are boards actively thinking about this?
Yeah, I have some version of this conversation in every board meeting. I was at a board meeting yesterday in San Francisco, and we were talking about future fundraising and the timing of that. And what I'm hearing by and large is, if at all possible, you shouldn't be out trying to fundraise until January of next year, right? Like, do not go into this market unless you really don't have a choice. But if you can extend your runway, through cutting expenses or other approaches, such that it gives you the runway to get through, then you really don't want to be out in market right now. Certainly not in the second half of the year, with what everyone is expecting to be an extraordinarily volatile election, and the expectation is that investors are going to maybe take a half step back while we see where the chips fall there. And so I think the common refrain is don't go to market. We're seeing some inside rounds to bridge to companies so that they don't have to get into market before then. I agree, though, there is a ton of dry powder. And for early stage companies, right, companies that were recently formed or companies raising a Series Seed financing, maybe even a Series A, I haven't really seen slowdown at all, right? Like, there continues to be an incredible amount of activity. I would even go so far as to say I'm seeing more highly respected entrepreneurs coming from blue chip software companies, starting their own companies than ever before. Now, the rationale would be those folks weren't leaving to start their own companies in 20 and 21 because they were sitting on paper equity that was worth an incredible amount of money and they couldn't exercise it. Now, maybe your company, your options aren't worth that much, and so you can leave those behind, go start your new company. Obviously, a lot of focus on AI, but other industries as well. And so at the kind of very early stages, I'm seeing some really impressive entrepreneurs spinning out, starting their own thing, getting term sheets almost pretty quickly thereafter. And that's great news for like the long-term health of the tech ecosystem.
Yeah, we're definitely hearing situations where folks are lamenting a Series A that was preempted at a very high price, and people saying this feels like 21 for some reason, and not just in AI.
Yeah. I mean, I had a founder, formed the company, and 3 weeks later they had 5 term sheets. I was like, wow, I haven't seen that one.
Yeah.
Oh, this is like 21.
Yeah.
But if there is an impasse, let's say in valuation, and they need to do a financing,
Yeah.
how do companies get through that? So they have investors, but they're not
Right.
quite willing to go where.
But I mean, I think that's where the the term structure comes into play, right? And so we're certainly seeing deals get done, and you can opt for the clean deal, and that's going to generally mean valuation's probably going to be significantly depressed from your last round. That might be the right answer. Take your medicine. The common feedback I hear from clients and management teams is employee morale concerns, right? Is, gee, if we have to go and tell our employees we're now doing a financing that we're valued at 10% of the last round, that's going to shatter morale. People are going to hit the exits, et cetera. So then you start to say, well, gee, how can we preserve some valuation? Maybe not the last round, but something higher than that. And that's where you start to see some of these structured terms, accruing dividends, liquidation preference multiples, or participating preferred, redemption rights. So it starts to look a lot more like dequity, right? Where, gee, if it's got an accruing dividend and participation and a redemption right, that starts to feel a little more like debt than true equity. But that's how investors can ensure, okay, you pick the valuation, we pick the terms, right? And that helps us protect our investment. So we're certainly seeing a lot more structured deals than we did, a few years ago, and it really goes to the valuation, right? There's a price for a clean deal, and then there's a price for a higher valuation.
Yeah, I think there's definitely.
Would you agree?
Yeah, there's definitely more creative conversations happening around terms, valuations,
Right.
et cetera. I do think we're still fundamentally in a market of haves and have-nots, and so for A+ companies that are growing efficiently with a bunch of wins on the board, for a consistent period in interesting markets, those A+ assets can still command old world terms, clean terms, if you will. But for everybody else, those conversations that Michael mentioned are certainly happening and being pushed into the narrative of just, hey, how do we constructively get a deal done here that everyone feels good about?
Yeah, and I add to that, in addition to the equity piece, and it's obviously correlated, but we're also seeing an uptick in kind of not only the credit funds, but converts as well. So as companies, and very similar structure to it with converting with warrants and at a set price, and a lot of them will liquidate with terms post-IPO or convert post-IPO. but we are seeing an uptick in not only companies starting to leverage that, but also in firms starting to pool capital specifically for those special situations. And I think that's been a trend we're seeing again over the last, call it, year or so. But now a lot of those companies are saying, hey, maybe they did that extension round, they did Series D and then the Series D won. But they still need a little cushion to get them over the hump as much as they're driving additional operational efficiencies. So then they look to the convert market as an opportunity to extend that runway.
Yeah, that was kind of the convert popularized by Uber back in like 2014 or so. And I remember, that really broke new ground when we did that deal, right? Because it wasn't a convert into a future round, it was a convert into the IPO at tiering discounts. And so the longer they took to get out, the higher the discount, which is really what helped drive them out eventually, was they got to the end of that runway. And so that's the danger of doing that. Of course, there's the benefit to it, but then it's the best laid plans that we're targeting to go out. But if that starts to slip, that discount can really tear up and be pretty impactful at the time of the offering. The other thing I would say, though, we were talking about convert, but just straight debt.
Yeah.
I mean, it was a year ago, right? We had the SVB crisis.
Right.
But out of that, I would say, and Tim and I certainly went through this recently, right? Like, the debt market is actually maybe even in a better shape than it was before that, because you have so many new challengers, right? Before it was, okay, you had SVB and they had this massive market share, but kind of coming out of that fallout, you have, of course, SVB that's still saying we're here and we're company friendly and we'll give you good terms. But you have all these other banks that say, well, we're in the game now too, and here's our terms. And so I've had plenty of companies go looking for debt and have multiple term sheets on competitive terms. Now, you then have the board members say, well, gee, do we want to take debt on a company? We'll ultimately have to service that. And so you do get some, are we sure we want to use debt to try and grow this business unless we're damn sure we've got the flywheel? But I would just say as a general matter, I think the debt market has actually improved, notwithstanding the crisis.
Yeah, it definitely feels like a much more distributed, even playing field, if you will, and folks kind of building out, trying to figure out, where they're going to cement themselves in different pockets of the market going forward. I think we've been benefactors of that.
Yeah.
We're involved in.
So we've talked about the public market, the private market, structuring transactions to extend runway. Where do strategics play in the next 12, 18 months? They've been holding back a bit, but are they going to get back into the market given valuations have moderated?
Yeah, I mean, so I think the one place where there's less sensitivity around valuation does tend to be the strategic investors. And certainly most of the large companies these days have some strategic arm. Some places it's more formalized than others. Salesforce has an extraordinarily large program, right? But even folks that don't have a separate arm like Salesforce are doing venture investing. And even late stage private companies like Databricks, right? Very active now. And they tend to be less valuation sensitive because there's some larger reason that they're investing into the company, right? Maybe it's a future acquisition target, maybe it's a partnership, maybe there's going to be some type of commercial arrangement. And so I have been in plenty of boardrooms where we're talking about fundraising and maybe we've tried to talk to some financial investors and that's not going well. And then it's, hey, let's talk to some strategics, right? Let's see if we can get them interested, some folks that we're already partnering with or we have commercial relationships. They're active investors. Let's go see if they want to invest. And so I do think that's been an area where there's less susceptibility to like valuation fluctuations, and because of the overall existing partnership or potential future partnership is a place that a lot of companies are exploring right now.
Yeah, and I'd say an interesting anecdote related to that was as we looked at those 3 IPOs in September of last year with Arm, Instacart, and Klaviyo, each had a strategic as a cornerstone or an anchor investor in that IPO allocation. So Arm, they had NVIDIA, Amazon, and Apple. Instacart had Pepsi, and Klaviyo had Shopify. And they had a strong, long partnership with Shopify heading into that IPO. But then as you look at the cover, each deal had those anchor strategic investors. So I think it's something that as we get back to get to the IPOs, that'll be another option in the playbook.
Yeah, I think we're always encouraging our companies to keep an active dialogue with strategics. I mean, you guys have touched on the investment arm, but from an M&A or potential exit perspective, I'd say those conversations are as active as or robust as they've ever been. Not to say that they're throwing in term sheets unexpectedly, but they're clearly intrigued, and in certain cases, I think they recognize that they may have a really attractive currency right now for those that are performing well in the public markets, and they're trying to figure out where they can go deploy capital in the private markets.
They've been out of the market for quite a while.
Yeah.
And building those relationships is so important. It's, it's an old adage, but it's true for a reason, which is companies are bought, not sold, right? And so I have companies that going out to start a sales process, hiring a banker or whatever, but they don't know who you are. It's that much harder, right? And so if you're developing the relationship, right, a lot of times the potential relationship isn't even about investing. It's like, let's get to know each other. Let's think about ways we can partner together, right? Maybe that starts with an investment. Maybe it leads to M&A discussions or commercial or partnership. But making sure the logical buyers in your space know who you are years in advance of selling. Then when the time comes, they already know you. They have a relationship. They've seen the evolution, right? It makes it so much easier.
Yeah. Well, we can't end talking about financing without talking about an election year. And we don't have to get into everyone's politics, but what's the advice here for anyone who does have to find some liquidity in the next 9 months?
Yeah, I mean, I what I'm hearing is I think it's going to be tough in the second half of the year. Certainly, I think going public, I think anyone that's going to try and get out is going to squeeze into that Q2 window. I don't think folks are going to want to go out in Q3 on the eve of the election. The window historically in Q4 is always very small anyways. And the aftermath of the election, I think that's probably pretty unlikely. So I think it'll be companies trying to jump in the Q2 window and then maybe sitting out until 25. I think, I think it's going to be a slowdown. I think generally is what I'm hearing, because folks are going to be nervous about, the rhetoric and the volatility of the markets heading up to it, and then what might happen afterwards, right? It's not just in the election and then as we saw 4 years ago, right? Like, the aftermath of the election could also be a pretty volatile time. So I think folks that have to do something, they're trying to do it in the first half of the year before we get too close to that event.
Yeah, I think it's, on that topic has been pretty linear advice and thinking. I wish there was more nuance to it, but having sit through a number of pitches and things for assets that may be coming to market this year, the advice has been universal. Try to be on the front side of late Q3, Q4.
Yeah, and I'd add to that very similar sentiment broadly. As we looked at 2012, 2016, 2020, just to that point, again, different variables, right? So that was the ZIRP time. But you had IPOs all the way up until late October. And then interestingly, in 2020, post that election, as much as that was a fiasco, 2020, December 2020, DoorDash, Airbnb, Samsara, PubMatic, Wish. So their deals can still get done. It's just going to be what is the broader market sentiment, and are investors looking for new issuance at that time? And I think that broader rhetoric this year is different. So one, you've got the Fed rates. We've got the meeting coming up in a few weeks. It sounds like they'll stay unchanged. They'll have another Fed meeting in May. The market futures are kind of baking in maybe 75 basis points this year. So that some conviction around what the Fed's going to do will help kind of dampen some of that volatility. But I think broadly the sentiment is we need to be ready to hit this window, and if not, unless there's a real need to go, there could be deals in kind of late September or October, but the majority are looking at a 25.
I think virtually every tech company would be willing to take valuations from December 2020. So
Sure.
I think a very different environment, notwithstanding the election this year. But that just the go-go days, really. I mean, that was like the height
Right.
of what we were seeing of valuations then. So that also very different for this year.
Yes.
So the headline: get it done now, or wait until the second half of 25. Well, thank you very much for listening to us. Thank you to the panel for participating.
Thanks.
And have a great rest of the conference.